Hello, federal employees. This is Sierra with Plan Your Federal Retirement. Thank you for joining me on today's Follow-Up Friday, where I will be covering the highlights and action items from this week's episode. In episode 81, Micah Shilanski and our special guest, Floyd Shilanski, discussed what to have in savings. It's summertime, and as Micah and Floyd are talking to our clients, things are coming up with our RVs or boats, and they're needing funds. So the question that came to mind for us is, what do you need to have in savings, not only while you're working, but also when you're retired? Floyd answered that while people are in their careers, they should have 3 to 6 months of living expenses. This should be what you're actually spending today, not a reduced budget that should be set aside. Floyd mentions that as you're getting closer to retirement, about 5 to 7 years out, Floyd likes to see our clients have about 3 to 4 years of their living expenses, what is actually being spent today, in a savings account for when they're getting ready to make that transition into retirement. Micah digs deeper into what a savings account actually means and the different types of accounts. Are we talking about retirement savings, a travel fund, an emergency fund, or savings in our buckets for the first 5 years of retirement? Micah discusses how this can be a little confusing for our clients and audience because savings is such a broad and global term. Floyd likes to be intentional with our clients, nicknaming your emergency fund to say 911 account on it and not just letting it be a savings account to help our clients be more intentional about their accounts. Floyd gives the example of having a travel fund that you put money towards each month, or a play fund like he has for his airplane settings. The 911 account is an "oh no, the world is coming apart and now I need those funds" type of account. That way our clients have peace of mind and know that they have money to do the things they want to do, but also they have money in case something happens. Micah pulls a thread of nicknaming the accounts. He likes to ask clients what bank they are primarily banking at for their main checking and savings account. Micah does not want their savings to be at that same bank. Micah describes the financial thermostat and how we have a range between X and Y of where they like their account to be at. If it goes above Y, then you can feel good about spending a little money. But if it goes below X, then oh no, let's stop the spending and bring it back up. Micah's hack for this is to separate the operating account and the long-term savings account to separate banking institutions. That way, when you log in to see that you have money to spend in your operating account, you do not even see the savings account balance and feel like you have that money to spend. Floyd added to that on how it adds another step before you even spend the money. Generally, people will talk themselves out of spending that money then due to the extra step. Floyd brought up that when we meet with our clients, we always take a pulse of where their checking and savings accounts are at. If the checking accounts are a little higher, he recommends moving some of that over into a savings account. Floyd says, out of sight, out of mind. Micah uses a local bank for his checking account, but then an online bank for his savings account. Micah clues us in on the secret to nicknaming your accounts with 3 things. What is it? When is it for? And how much is it? Micah uses the example of a married couple and they have a travel fund. One spouse might think that's for a hunting trip, and the other spouse might think it's for a trip to Europe. If you label the account Europe, May 2024, $12,000, for example, then everyone is on the same page and being intentional about their savings. This does not permanently commit the money towards that, but it makes your savings intentional. If you have the funds and what you need in that account to go on the trip, then you can go on the trip. But if you don't have enough money in the account, then the good news is that you're going to keep saving up for that trip. Floyd brings up another great point about being disciplined. Yes, you could transfer the funds from another account if you come up short. You can move funds from a travel to an airplane fund, for example, if you want to reallocate, that's perfectly fine. However, you should not be moving money from your 911 account to a fund savings account, for example, spending for a trip. Micah talks about why we call it a 911 account versus an emergency savings. If a client calls in and says, hey, it's an emergency, my boat motor went out, the boat is mainly for fun. Even if we do fill our freezers with fish, it's not really an emergency to replace the boat motor. You just really want to replace the boat motor. Examples of emergencies would be your heat going out on your house in Alaska, a roof leak, a foundation damage from an earthquake, or you lose your job from a government shutdown. Floyd says that clients frequently ask us what that magic savings number is. He answers how much should be in those accounts really depends on the clients. If an emergency happens, insurance may cover it, but then there may be an interim time when you file a claim before you get the funds from an insurance company. That's where your emergency account comes in to give you peace of mind. Micah reiterates that you should have 3 to 6 months worth of what you're spending. What is the amount that comes into your bank account every 2 weeks? Take that number and times it by the 3 to 6 months, and that is the number that you should have. It could be a higher number, more than 6 months, depending on your career and some other factors. But Micah said he has never seen it where it should be lower than 3 months. Micah discusses when you retire and you don't have your pension or supplement yet. Micah adds that this is where we like our retirees to have 6 months, maybe even 12 months of expenses outside of your retirement accounts in emergency reserve. Floyd also gave the example of an executive who was going to take time off and take a sabbatical, so they ramped up that emergency savings in anticipation of this happening. Micah says that it's better to plan to have too much cash saved up than to not have enough and then need it. Micah brought up the question of where do you exactly put these funds and in what type of an account. Micah suggests an FDIC insured money market account or a short-term CD. Micah is not a fan of a long-term CD because 5 years is usually too long for when you are earmarking the funds to be spent. Floyd adds that just because the account is a money market account does not mean that you're getting the best interest rate. Floyd says to ask the bank, what is the current interest rate of that account? Then to ask if they have any accounts that are doing a higher interest rate than that account. Micah cautions about a better interest rate and understanding what strings are attached to that. Micah admits that he even falls victim to this and says we all need to ensure that we're staying on top of our accounts. Just because it was the rate you were getting before does not mean that the bank didn't change it. If it is a significant change in interest rates, then it might be worth the time to make the change in your account. Micah suggests logging into your accounts on a semi-annual basis and reevaluating if your accounts are best suited for you. This podcast is all about action items for our listeners. Our first action item is for our younger working audience, ensure that you have 3 to 6 months of living expenses set aside and look at your savings account and see what interest rate you're getting. If you're approaching retirement in the next 5 to 7 years, you should have 9 to 18 months, maybe even 2 years of living expenses set aside. Our second action item, separate your operating checking account from your savings account by putting your savings account at a totally different bank to help with your financial thermostat. It seems small, but try it for 6 months and you might be amazed at how much you're able to save. Our third action item, re-listen to the original episode 81, to hear the amazing conversation between Micah and Floyd. Our fourth action item, register and block out time on your calendars for our next live webinar on August 10th, 2023 at 12 p.m. Eastern Time, where we answer your most frequently asked questions. And finally, share this podcast with a friend. With your help, we can achieve our goal of helping 1 million federal employees just like you.